The average American household spent $78,233 on consumer goods and services in 2024. That number went up 5.1% from the year before. At the same time, wages only grew by 3.8%. The math is simple and uncomfortable. People are spending faster than they're earning. The gap between what life costs and what people actually bring home keeps widening, quietly, year after year. But the real problem isn't just inflation, it's something more specific. A large portion of that spending goes toward things that used to make financial sense but no longer do. Products and services that once offered genuine value have slowly transformed into systems designed to pull as much money out of your pocket as possible while giving you as little as possible in return. Prices have climbed, quality has dropped, and most people haven't stopped to notice because the habits formed years ago, long before the numbers changed this dramatically. This isn't about living without comfort or pleasure. It's about understanding where your money is actually going and deciding whether those choices still hold up when you look at them honestly. 6 categories in particular stand out in 2026, not because they're unusual purchases, but because they're things millions of people spend money on every single week without ever running the numbers. When you do run the numbers, the results are hard to ignore. There is probably no spending habit more normalized right now than ordering food through an app. DoorDash, Uber Eats, Grubhub, these platforms have genuinely changed the way people eat. They've also changed, very quietly, how much people pay for the privilege of eating that way. The economics work like this. Delivery platforms charge restaurants a commission fee somewhere between 15 and 30% on every single order. Restaurants don't absorb that cost themselves. They pass it directly to you through higher menu prices. Studies have found that items on delivery apps are priced approximately 25% higher than the same items ordered at the restaurant or purchased in-store. And that's before a single fee has been added to your total. Then come the fees. There's a delivery fee, a service fee, sometimes a small order fee if you haven't hit a minimum purchase amount, a tip for the driver, occasionally a surge charge during busy hours. A meal that costs $12 at the restaurant can easily become $22 on the app. That's an 83% markup for the convenience of not driving 10 minutes. According to research from Gordian Knot Advisors, delivery app prices have climbed an additional 8 to 12% since 2023 alone. The gap keeps growing. The convenience argument made sense when delivery was something people did occasionally, a late night, a sick day, a genuine exception. When it becomes a routine 2 or 3 times a week, the financial damage is significant. Someone ordering delivery twice a week at a $15 premium per order is spending an extra $1,560 every year just on the markup and fees. That same amount invested at a modest 8% annual return over 20 years grows to roughly $7,800. One habit, one weekly routine, thousands of dollars transferred from your future to a corporate platform. The apps are designed with this in mind. Every interface detail, the one-tap reordering, the saved payment methods, the subscription passes that create a feeling of savings while guaranteeing consistent usage, exist to make spending feel effortless. In 2026, food delivery as an occasional convenience still makes sense. As a weekly habit, it has become one of the most expensive small decisions most people make. The moment a new car leaves the dealership lot, it loses approximately 20% of its value. On a $48,000 vehicle, which sits close to the average new car price in the United States in 2026, that's $9,600 gone before you've reached the end of the street. By the end of the first full year of ownership, total depreciation typically reaches 25 to 30%. The $48,000 car is now worth somewhere between $33,000 and $36,000. You have lost more value in 12 months than a year's rent costs many Americans. If you financed most of the purchase, the situation becomes worse. Negative equity, meaning you owe more on the loan than the car is currently worth, happens almost immediately for a large number of buyers. You can't sell the car without bringing cash to cover the difference. You're effectively locked in. 5-year-old vehicles occupy a sweet spot that new car buyers tend to overlook entirely. A car that's 5 years old has already absorbed the steepest part of its depreciation curve. It typically doesn't require major repairs yet. Modern vehicles routinely last 150,000 to 200,000 miles with basic maintenance. If you buy a reliable 5-year-old car, drive it for 3 or 4 years, and sell it before serious mechanical issues become likely, the depreciation you personally experience is minimal. You can often sell for close to what you paid. The same pool of money keeps cycling from car to car rather than disappearing into depreciation losses. The average monthly payment on a new car loan reached $738 in late 2025, according to Edmunds. That's $8,856 per year before insurance, fuel, or maintenance. Someone buying a quality used car with cash eliminates that payment entirely and redirects nearly $9,000 annually towards something that actually builds financial stability. Studies on millionaire behavior are remarkably consistent on this specific point. The typical millionaire drives a Toyota, Honda, or Ford with a median vehicle purchase price around $31,000. They view transportation as a utility, not a statement. New cars in 2026 are financial sinkholes dressed up as lifestyle upgrades. Restaurant prices in the United States have increased 35% since 2019, according to the Bureau of Labor Statistics. A standard hamburger at a casual sit-down restaurant now costs between $16 and $22 in most markets. Add a drink and an appetizer, and a single person is approaching $40 before leaving a tip. Two people having a moderately nice dinner with drinks can easily spend $100 to $140. That same dinner would have cost $50 to $60 just 5 years ago. The value proposition has inverted. Prices have roughly doubled while portions have quietly shrunk. Service has declined as restaurants struggle with staffing costs. The experience itself hasn't improved to justify what's being charged. And the markup on beverages is where the real extraction happens. A $14 cocktail contains about $2 worth of ingredients. A $4 soda costs the restaurant approximately 15 cents. Coffee often carries a markup of 2,000% or more. Drinks aren't add-ons to the dining experience. They're the primary margin driver, and they exist specifically because food margins have compressed to nearly nothing. The time cost compounds the financial cost. A sit-down dinner takes 90 minutes to 2 hours from leaving the house to returning home. A comparable meal prepared at home takes 25 to 30 minutes and costs a fraction of the price. None of this means restaurants have no place in life. A meal celebrating something meaningful carries value beyond the food itself. The problem is the weekly habit, the casual Thursday dinner, the routine Friday night out, that many households maintain without ever calculating what it actually costs them. A family spending $200 weekly on dining out spends $10,000 to $400 annually. That same family could eat well at home for around $600 a month, saving more than $3,000 per year while likely eating healthier. The math has shifted. The habit hasn't caught up yet. Streaming was supposed to be the affordable alternative to cable. Pay $8 a month, cancel anytime, access everything you want. That was the original offer. It no longer resembles what the industry has become. Netflix's standard plan now sits at $15.49 per month. Disney Plus runs $13.99, Hulu is $17.99, HBO Max is $15.99, Amazon Prime Video adds $8.99, Apple TV Plus charges $9.99, Peacock runs $7.99, Paramount Plus is $11.99. Subscribing to all of the major services simultaneously costs over $100 per month, more than $1,200 annually. That exceeds what many households were paying for the cable package they canceled. The content fragmentation driving this is intentional. Each platform has exclusive content specifically designed to make cancellation feel costly. The show you want to watch migrates from one service to another. A film you've been waiting for appears on a platform you don't subscribe to. Sports require yet another separate subscription. Every platform is working to reassemble the cable bundle, just sold to you one piece at a time at a higher combined price. According to Deloitte's 2025 Digital Media Trends Report, the average American household actively subscribes to 4.5 streaming services, spending between $60 and $75 monthly just on content access. The straightforward solution requires one thing most people find difficult: discipline. Subscribe to a single service, watch what you want on that platform, cancel it, move to the next one. Rotate sequentially rather than maintaining everything simultaneously. This approach costs $12 to $18 per month instead of $75. The content is still accessible, just not all at once. In 2026, streaming only makes financial sense if you're willing to play by different rules than the ones the platforms designed for you. Fast food built its entire brand identity on one promise: cheap, quick, and accessible. That promise no longer holds. A Big Mac meal at McDonald's costs $12 to $15 in most American markets. A Chipotle bowl approaches $15. Even Taco Bell, historically the most affordable major chain, now charges $10 to $12 for a standard meal. Fast food prices have increased 55% since 2019. Menu prices rose nearly 10% in 2023 alone, according to the Bureau of Labor Statistics, and the trend has continued. The core value proposition was never about nutrition. Everyone always understood that. The value was convenience at low cost. Once you remove the low cost, what remains is convenient, nutritionally poor food at premium prices. For $15, a meal prepared at home using real ingredients, vegetables, quality proteins, whole grains is not only possible but straightforward. Most simple home-cooked meals take 15 to 20 minutes. The time difference between fast food and cooking at home has collapsed to nearly nothing. The financial damage from a consistent fast food habit adds up faster than most people realize. A regular fast food customer spending conservatively can easily reach $3,000 to $5,000 per year across meals and drinks. That money is simultaneously funding poor health outcomes and corporate profit margins. Fast food made reasonable financial sense when a full meal cost $4 to $6. At current prices, it fails the basic test of value on almost every level. A new flagship iPhone costs approximately $1,200. It takes marginally better photos than the model from 2 years ago. It runs the same applications at speeds that are functionally indistinguishable in daily use. It provides the same core experience, calls, messages, browsing, social media, that phones from 3 or 4 years ago already provided completely adequately. The performance gap between smartphone generations has narrowed to near zero for the overwhelming majority of users. The iPhone 16 versus the iPhone 13 offers almost nothing that a typical person would notice or care about during a regular day. The camera improvements exist on paper. The processing speed improvements are measurable in benchmarks. Neither translates into a meaningfully different life. Planned obsolescence keeps the cycle running. Manufacturers slow older devices through software updates. Battery performance degrades in ways that feel timed. Repair costs are priced close enough to replacement costs that the rational choice keeps pointing toward a new purchase. The entire ecosystem is structured around constant replacement, and the marketing around each new generation is engineered to make incremental improvements feel revolutionary. The financially sound approach is to buy technology 1 or 2 generations behind whatever is currently being launched. A refurbished iPhone 14 costs roughly half what a new iPhone 16 costs. It handles every task the average person needs a phone to handle. The performance difference in real use is undetectable. Someone upgrading to a new flagship phone every 2 years spends approximately $600 annually on depreciation alone. Money that invested steadily over a career compounds into tens of thousands of dollars spent chasing camera improvements measured in fractions of a percent. These six categories share the same underlying structure. They exploit familiarity, convenience, psychological friction, and the simple fact that most people form spending habits before they calculate what those habits actually cost over time. Each one, on its own, represents hundreds or thousands of dollars per year. Combined, they represent a significant portion of the financial gap that keeps most households from making real forward progress. The question isn't whether any of these things ever make sense. Some do, in the right context at the right frequency. The question is whether the spending is a conscious choice or simply a pattern that formed before anyone stopped to examine it. That gap between habitual spending and intentional spending is where most of the money quietly disappears. Understanding it is the first step toward changing it.